make a start. Well, good morning, everyone. Thanks for joining us at this second Revolution Asset Management webinar for the year. I'm Byron Slesser from Channel Capital, and today I'm joined by Bob Sahota, Chief Investment Officer and co-founder of Revolution, and Simon Petris, Senior Portfolio Manager and co-founder of Revolution. So we're going to try and keep the session today to 45 minutes. So there'll be a presentation from Bob and Simon, and then some Q&A at the end. So as always, if you have some questions, please use the Q&A button at the bottom of your screen and ask your questions. We'd love to hear from you. But yeah, as I said, we're trying to keep this to a 45-minute session. So I'll hand over to Simon and Bob in a sec. The focus today will be a bit more on asset-backed securities, given some of the questions we've had around the market over the last 3 to 6 months. So yeah, Simon will be leading that session. But thanks, Bob. Thanks, Simon. I'll hand over to you.
Wonderful. Thanks, Byron, for the introduction, and good morning, everybody. Welcome to the Revolution Asset Management webinar. I want to firstly, as we always do, thank you for all the client support and all the advisor support that we've enjoyed over the last 5.5 years in really achieving some of the goals that we've achieved. Couldn't have done it without all the support from a lot of you, the clients that are dialing in. A quick whip around, we're now up to $2.5 billion of committed capital. In terms of Fund 1, which was our inaugural fund, it is now very much in harvest phase. So currently it sits at $169 million in the fund. It was originally 205. And as those deals in that fund mature and repay, we are returning capital in that fund. And obviously there's an opportunity for any funds coming back to be deployed into our open-ended vehicle, which is Revolution Private Debt Fund number 2. To give people who are invested in Fund 1 a bit of an idea and update, we expect between 20 and 30% of that fund capital to be returned by year end. It's now got 18 loans, but we expect there's going to be at least 4 or 5 loans repaying. Private Debt Fund number 2, which is our flagship fund, is now up to $1.9 billion with strong inflows. The yield to maturity, which we'll talk about, has benefited from the increase in the base rate. And obviously everything we do in terms of our 47 loans are all floating rate loans. So they have enjoyed much higher yields as the base rates have increased. About 3/4 of our funds under management are from institutional clients, pension funds, and about 1/4 is from the wholesale feeder vehicle. So again, thank you for all of that support. We have 2 institutional consultant recommendations from Jana and Mercer, and we have a major research house in Zenith, a recommended rating from them. We maintain a very strong discipline, and we still have a pretty strong deal approval rate in terms of being very selective, of around about 25% of deals that we see actually make it into the portfolio. And we're very ably assisted in terms of the 5 of us on the investment side, with the very strong support that we enjoy from Channel Capital as our investment partner right from the get-go. This is a slide that should hopefully, for many of you, not be a new one. We always cover what the areas of investment specialties that we cover. But it's important to understand, and a lot of people are now talking about private debt much more so than in our 5.5-year history, and indeed my career that is much longer than that. In talking about the attributes of private debt, it's important to know that really that it spans a very wide risk return spectrum, all the way from very, very safe and secure lending money through a loan to a corporate is also private debt, all the way through to special situations, property construction development risk, which we'll talk about, and also lending to smaller companies. We really focus on 3 key areas: lending money to established real estate with good quality tenant cash flow, which is at the lower end of our risk spectrum. Then we are very, very strong supporters now in the Australian market to leverage buyout lending. This is providing senior secured loans to large-scale acquisitions. When private equity goes and acquires companies, we're part of a strong consortium of banks and other lenders that provide that senior secured risk and loan to those sorts of opportunities. And asset-backed securities. So whilst we may not engage in directly doing mortgages or providing auto loans or credit cards or personal loans, we are strong supporters of non-bank lenders throughout Australia and New Zealand. And Simon's going to be spending a bit more time diving a bit deeper into how we think about asset-backed securities in this overall macro picture that we face going forward. So maybe next slide. This is a slide that we use to talk about how our portfolio yield has changed over time. The light blue line that you see is our credit margin across our 47 loans that we have in Revolution Private Debt Fund number 2. And you can see there that it's been remarkably stable in the sort of high 5s to 6% right throughout the period since inception. And the grey bars are really, as it comes as no surprise to anyone, the rapid increase in base interest rates. And you can see that there, with a small lag, that then translates into our yield that we forecast for the next 12 months, increasing in line with base rates. And if we get, as most economists believe, another 1 to 2 more rate rises, we'll continue to track upwards in terms of the yield for our portfolio. So today we expect that the portfolio, as it currently stands, will generate a 10.2% return for the next 12 months based on the investments we've made to date. It's really important to talk about what we do in terms of the loans that we make, and also, more importantly, the loans we don't do. I get often asked by prospective clients and customers, should we be going into private debt right about now? And my answer is one that might surprise a lot of you. My answer is you should absolutely not go blindly into private debt at this point in the cycle. We certainly believe, and we're fixed income guys and we're sort of debt guys, we don't get paid for upside, but we certainly have a view that we're going to have a much more challenged macroeconomic picture going forward. And in that environment, you have an increase in corporate defaults and a lot more pressure coming from those rapid 12 interest rate increases, and also cost of living pressures and inflation starting to really impact the economy. So what are the things that we've done in order to make sure that our portfolio is in good shape to be able to deliver the return that we promise our investors? And remember, in Australia and New Zealand, we don't have the benefit of being able to trade out of deals. There's no secondary market in many of the loans that we make. So it's really the way that the portfolio has been constructed coming into this next 12 to 18 months that will be the defining factor in whether a private debt manager and a private debt strategy is able to withstand the kinds of pressures that we expect. So in all three sleeves, let me quickly go through those. In leverage loans, we have really avoided cyclical companies. Why is that? When the cycle turns and you've got higher leverage, this is where companies that have got more cyclicality to them come under a lot of pressure. That's really companies like retail, tourism, hospitality, mining. These sorts of companies are ones where higher leverage really comes to really bite at times where the cycle turns. We avoid those sorts of businesses. We also avoid smaller companies and SME lending. You can have all the protections in the world. You can have security, you can have covenants. But if you're lending to smaller companies, these are typically companies that can no longer pass on input price shocks to their end customers because they have weaker positions of power. So what do we like? We like defensive industries like healthcare, consumer staples, mission critical software, companies like Healthscope Hospitals, MYOB, Arnott's Biscuits, so household names, Paddy's in terms of the frozen food category. Very good defensive industries and good businesses that have got a very strong ability to generate cash flow through the full cycle and have got the market share and the moat around their businesses to be able to deliver that cash flow that really we rely on to pay our debt. In terms of real estate debt, it's been a very lean period for us to be doing real estate debt, even though there's been bountiful deals in the construction development area. I've been very vocal in the last 12 months about really the issues that are really impacting the real estate construction development market. We're starting to see really the cracks starting to appear. We've never done and will never do construction development loans. They are high risk, high return. You can make a lot of money, but then you give it all back at times over the next 12 months, in my view. We also don't just look at valuations, which are very under pressure now. And in many cases, there's a lot more being written about stale valuations in periods where cap rates are now below, in some cases, the actual risk-free rate. We've maintained a lot of discipline, and we see potentially some opportunities coming for good quality property and real estate with good quality tenants that we can use our credit skills to be able to provide capital into that area, as I saw back in 2008 and 9 in the aftermath of the global financial crisis. So we maintain a level of discipline, but we see potentially more opportunities in real estate lending going forward. In terms of asset-backed securities, not stealing too much of Simon's thunder, I'm about to pass over to him, but we also maintain a strong discipline in backing only those non-bank lenders who have got strong businesses to begin with, ones that are profitable, ones that are well capitalised, have access to the debt capital markets as well as equity markets should they require injection of capital. We also have always targeted prime borrowing pools. Why is that? Prime borrowers have got a much better ability to fare through an economic downturn than weaker, smaller and weaker borrowers who are potentially younger and more casualised labour. So with that, I might hand over to Simon to go through a bit more on how we think about asset-backed securities, particularly in this period that we expect is going to be more challenging going forward.
Thanks, Bob. As mentioned, we're going to spend the next few slides looking a bit more into the ABS part of the portfolio, which is possibly a bit less well understood versus the LBO sort of corporate loan side of things. These are the sort of the broad main subsectors of ABS that we tend to look at, and we're reasonably well diversified across all of these sectors. Starting in the top right, probably the most familiar to people will be residential mortgages, where we're helping non-bank lenders build up a pool of mortgages secured by residential real estate. Moving around to the next section, auto loans. So helping them build up pools of auto loan receivables secured against the vehicles themselves. We also do a little bit of small ticket commercial CMBS lending, where the underlying security is small commercial office and retail offices. The other sectors are equipment finance, where we help non-bank lenders build up pools of equipment loans secured against critical business equipment. And the final sector that we're involved in, and probably the one that we've received the most questions about and people wanting to understand more is the consumer finance, where we're helping non-bank lenders build up pools of receivables secured against things like personal loans and credit cards, which are effectively unsecured in nature. As lenders to asset-backed securities, we tend to focus predominantly on the private warehouse side, where there are a number of structural protections that are common to all of these subsectors. Firstly, there's the excess spread in the pool of receivables. That's the difference between the yield on the assets versus the cost of financing. And this is really our first line of protection against any losses. Then there's the actual sort of underlying the fact that the receivables are in an SPV, and that the originator has to put in the first loss, which effectively helps to give us a buffer against any losses that might occur in the pool. And then we're also very involved in negotiating the eligibility criteria of the loans that can go into the warehouses, and broadly restricting the portfolio parameters, so we don't build up too much concentration to a particular type of loan. So moving on to the next slide, we might give you an idea of why we're involved in the sort of consumer finance side and why we see it as a significant source of alpha. And one of the ways to do this is to compare this to the type of spreads that are available in the US market. So essentially, the team has been involved in investing and trading consumer finance for more than 15 years. And really, in the US market, it's a very well understood and almost vanilla asset class. And you can see the type of credit margins over the floating rate swap that are available in the US. Prime consumer ABS, triple B is only at sort of a 150 margin over swap because it's very well understood that they trade very readily and at relatively tight spreads. And if you even look at getting into the sort of the hairier section of the US market, the subprime auto ABS market, you can see the type of spreads that are available there for the different credit rating levels. Double B's at only sort of 500 over because it is so well understood, and it trades. It's a relatively vanilla asset class. The reason why it's seen as more of a niche and often misunderstood asset class in the Australian market is because essentially the big four banks, prior to the last 5 to 10 years, really dominated consumer credit in the local market, and there wasn't really a lot of issuance of these type of securities. So the market isn't as familiar with them, and as a result, we see extremely strong alpha possibilities by investing in these asset classes. As you can see on the sort of the public prime auto ABS and prime consumer ABS, they're typically around 200 basis points wider on a public market deal. And then for us as private ABS warehouses, we receive an illiquidity premium on top of that, which is like an extra 200 basis points. So we really do see that as a significant source of alpha for the portfolio. I think the natural question to ask would be, if we're getting paid so much more for investing in Aussie ABS, why is that? Is that because the underlying receivables and the borrowers are more risky relative to the US? Well, anyone that's sort of seen the Big Short might have an inkling that actually the opposite is true. But if we move on to the next slide, we've actually taken this graph from a paper produced by the Rating Agency Standard & Poor's, which essentially shows the level of personal bankruptcies across Australia, Canada, UK, and the US. And you can see in the chart that, and this is adjusted for head of population, so it's not skewed by the fact that the US is a bigger population. You can see that the level of personal bankruptcies is highest in the US, and it's lowest in essentially Australia and the UK, which kind of rings true because the US has that very entrepreneurial, risk-taking sort of attitude when it comes to personal and business finance. And the S&P stated, a couple of reasons why this is the case. Traditionally, Australians have shown a strong willingness to repay debt, and there are severe consequences of bankruptcy, unlike the US, where many of the states are non-recourse and you can just hand back the keys on a property, for example. There's also a greater stigma associated with bankruptcy in Australia, and difficulty accessing finance after bankruptcy. And if essentially investing and owning housing in Australia is a bit of a national obsession, and people really take their credit scores and their ability to borrow to be able to get into the property market very seriously. And this is reflected in this chart in particular. If we move on to the next chart, essentially the first order risk in any in ABS pool is effectively, I guess, the default rate on the annual default rate on the underlying pool of receivables. And I know this is a busy chart, but essentially what we're showing here is the US experience, where we've got the red line is the US unemployment rate, and then the black line is the S&P credit card consumer finance default index. The yellow line is the auto default index, and the blue line is the mortgage default index. What you should first notice is that there's a strong correlation between the unemployment rate and the default rates of the various indices. Clearly, you can see that the credit card consumer default index has the highest beta effectively to unemployment, and that the auto and the mortgage being secured are sort of lower betas. Interestingly, during the GFC, the mortgage default rate in the US actually flipped over and became a lot higher than the auto default index, which is kind of a unique characteristic to the US market, where Americans love their their vehicles and they need them to get to work. Whereas because of that sort of non-recourse lending, and there are a lot of like ninja loans, no income, no job, lending at sort of 100% LTV. A lot of people sort of speculated on property, and that's how that bubble sort of began. And the default rate as a consequence during that period was abnormally high. You can see since 2010, really, as the unemployment rate came down in the US, the corresponding levels of default rate in the indices has come down commensurately, and this is across the three different asset classes. Unusually, you can see the big spike in 2020, where effectively due to COVID, this correlation did break because essentially people were put on furlough and unable to go to work, but they did receive compensation and benefits during that period. So it's not a really true reflection of the correlation. And during that period, because people did have a lot of the savings rate was very high and people had a lot of disposable income, they actually paid down debt, and the default rates came down to sort of record low sort of honeymoon periods. But as we're sort of emerging out of the COVID period and back to sort of a more normalized area, the default rates are going back to sort of to pre-COVID levels, and we expect that correlation between default rates and unemployment to come back. If you just note on this graph the kind of the peak default rates on consumer finance during the GFC was a bit over 9%, because I'll come back to refer to that on the following slide. We could move on to that. Okay, so this is the Australian sort of consumer finance history, which is effectively the data is not as readily available as it is in the US, because the asset class has been around, but it's been much more private, either funded within banks or in companies like Latitude used to be GE Money, and so that was a private company, and the information wasn't available. What we've been able to do is construct our own proprietary default rate index for the Australian market based on a number of the warehouses that we're involved with and our access to data. We've constructed the black line, which is the local version of the consumer default rate, and then we've put in the red line being the unemployment rate in the Aussie market. And as you can see, the correlation between unemployment and consumer default rates held very well, and it was very, very consistent over a long period of time. Similarly to the US, during the COVID period, we did have a lift in the unemployment rate due to people being on furlough and receiving benefits and stimulus payments, and then we did see a corresponding drop in the consumer finance default rate to record levels. But as we sort of emerged out of this period, we're starting to see default rates normalised. The dotted, can we just stay on that slide, please? Yeah. So the dotted line that we've got there is that peak US consumer default rate, a bit over 9% that I referred to earlier. What we've done is for every warehouse investment that we're involved in, we build a comprehensive cash flow model where we model out the assets and the liabilities and use the sort of structural protections. We model those into the transaction, as I mentioned before. And what we've come up with is effectively the average default rate being a bit over 13.5%, where we suffer the first dollar of loss on our lowest rated tranche in our warehouse investments, and it's a bit over 13.5. So we're currently, we'd need a 3.8 times pickup in the default rate before we suffered the first dollar of loss. And importantly, we would need the default rate to get to that level and remain there for a significant period of time. So essentially, we're talking about unemployment rates being well above 10%, double digits, for us to even approach any stress in our pools. So that gives us a significant level of comfort that being at a a 3.5% unemployment rate currently, we've got a large sort of margin of safety, which is why, we feel very confident that our investments are going to be able to withstand any tick up in unemployment, even if it gets to sort of 5, 6, 7%. We feel like we've got a very strong margin of safety before we are at risk of incurring any loss on our investments.
So Simon's done a great job of really diving deeper into the consumer finance portion of our investments. But I would say, across our overall portfolio and every single one of the loans that we've got, in terms of the 47 loans in private debt fund number 2, we are constantly looking at what can go wrong, what happens in a downturn, what happens in a recession. We are looking at, scenario testing to say, well, are we able to put hand on heart to tell our clients that we are the defensive part of people's allocation, and can we provide the continuous quarterly returns that we promise our investors? And that is why we are quietly confident about being able to navigate through the next 12 to 18 months. We are one of very few managers that have got the experience of managing through the global financial crisis in the domestic private debt markets. And we look forward to the next 12 to 18 months on being able to continue to deliver for our clients. Just a word on performance. So with the rapid increases in interest rates, there is a lag before you start seeing that translating through to the actual performance. And that's because on the asset-backed security side of the ledger, which is about half the fund, we have monthly rollovers, and therefore the base rate gets picked up on a monthly basis. But on the leveraged buyout loans, they're typically quarterly resets on interest rates. So it's a full 3 months before we see the benefit of that base rate increase coming through into performance. But you can start seeing, the most recent month of 79 basis points in June starting to translate back to a yield to maturity that translates back to a 10.2% gross. We've got, as I mentioned, 47 loans with an overall credit spread of 5.8% or 580 basis points. As I mentioned, it's all floating rate with very low interest rate risk. With the seasoning of the loans, we have a credit duration that's quite short as well, of 1.4 years. And the total fund is now even in excess of $1.8 billion, more approaching 1.9, with an average credit rating that we target, which is slightly below investment grade at BB+. Everything we do is secured in the portfolio, and that also gives us additional comfort through the period of being secured versus unsecured in a more turbulent period we expect that's coming. So overall, we believe private debt is a very, very interesting place for people to look to invest at this point, as long as you pick the right manager, you pick the right strategy, and it delivers what you expect it to deliver for your clients. If you've got a special sits kind of opportunity, you understand that's higher risk, higher return. It's better off that you pick the right managers and specialists in that space. What we believe is very much staying very core to our DNA, which is a defensive, non-correlated private debt portfolio that generates good, stable, transparent income every quarter for our clients. And that's where we're starting to build real scale. And with scale in this market in Australia, we get earlier calls, being able to shape the terms and conditions of these loans, getting the ability to fill our pipeline quicker than our competitors. So we look forward to growing the business with your support and being able to continue to deliver the return that we promise our investors. Might open up for any questions.
Great. Thanks, guys. Thanks, Bob and Simon. So we've got a few questions, but as I said at the start, please send them through if you'd like any questions answered by Bob and Simon. So first one here from Marco. So Chris Joy has said publicly to sell all private debt, given a massive default cycle is coming and wiping out all debt holders. You touched on this at the start, Bob, but what is your response to that?
I in some ways wholeheartedly agree with Chris Joy, and look, he writes very well and got great insights. I would say not all private debt strategies are going to fare the same, and ones that are more exposed to the cycle or ones that have not been as disciplined in constructing their private debt portfolios will come under more pressure in the next 12 months. What we're here to tell you, though, is we've got the experience to manage through this coming period, because in every deal and every fundamental deal that we've underwritten, we've actually tested those for the downsides. You saw in great detail the way that we approach when Simon talked about consumer unsecured finance. So blindly you'd think, well, consumers are going to come under more pressure, unemployment rates are going to increase. What happens to your unsecured pool of personal loans or credit cards? We build in great buffers before we approach anything that looks like a first dollar loss for our portfolios. And we do that across all of our deals that we've included in the portfolio.
Great, thanks, Bob. Here's a good question. So apologies I've missed this, but would Revolution consider utilising interest rate swaps to fix part of the portfolio, given it's likely we're approaching peak interest rates in Australia?
We get asked this a little bit. We are not guys that are going to sit here and talk about being able to predict interest rates. So we are very much have an ethos of, you tell us what the base rate is and we can deliver you a stable return. It's 5.8, 5.9% above whatever prevailing floating rate. We really think that if you want to have an interest rate view, you're better off expressing that with your own overlays or potentially giving it to a manager that is in the business of predicting interest rates. We all obviously, not obviously, but we have a view that interest rate markets are amongst the most efficient in the world. And it's notoriously difficult to be able to pick directions in that. And you can only see how many economists have got it wrong in terms of picking rate rises when they're expected to be on hold. So we really don't want to play that game. We really want to just deliver a good, stable floating rate return, which we benefited from. But the other thing is, we're not big forecasters. But if you look at history, the inflation when inflation gets above the breakout levels and the genie's out of the bottle, it is not a very quick fix. So if there's anything, we approach everything cynically anyway, but there's a cynicism on the yield curve at the moment where a lot of people are expecting we're going to be going into rate cut territory next year. We are certainly not of that opinion as a house that inflation will be coming under control that fast and that rate cuts will be coming. And if they do, think about when the RBA or central banks cut rates, it means that they're trying to stimulate the economy. And that is not a great time to be in risk assets anyway. So we will continue to be able to produce a good bedrock of income for our clients, even through those periods.
Thanks, Bob. Probably one for Simon here. Which non-bank lenders are you favouring and which ones are you avoiding?
Yeah. So this has been the same all the way through. We really favour the guys that have been around for a long period of time, that have seen multiple cycles. They're profitable, and they've really got the experience, and they're not sort of over levered on a corporate balance sheet perspective. So I think some of the originators like the open pays that have got into trouble. I think their pool of assets has been fine, but they've really spent too much. They haven't been profitable, and they've over levered their corporate balance sheet, and they've put themselves at risk from that perspective. So it's not the end of the world if an originator does go out of business as an ABS lender because the loans are secured in an SPV, not on the corporate balance sheet. So you can bring in the backup servicer to service the assets, but that's really a last resort. You'd much prefer to have a strong originator that's going to be there through thick and thin. So.
Okay, so there's another question here. So are there any LBOs or commercial real estate loans in the portfolio that are showing signs of default at this point?
So we have literally one loan that represents less than 0.5% of Fund 2 for Genesis Care, which we've been very open and honest about when it's had its fair share of issues. That particular loan, there's nothing fundamentally wrong with that. It was really a case of that company expanding into the US market for a very sizable acquisition in the US right before COVID hit, to the tune of $1.4 billion US. The integration of that US business was not handled very well. and leverage really spiked as a result of the underperformance of that division. We've progressively, through our very, very rigorous monthly process in terms of having a third-party valuation agent in the form of Leadenhall, look at every one of our loans and certify to the responsible entity of the fund, Channel Capital, that the loans are performing. And according to our valuation policy, if those loans are performing, we mark them at par. And that is true of 46 out of the 47 loans. The one where we progressively have marked that asset down as a result of the recovery rate type of analysis that we expect from our secured position is currently in the portfolio at a level that we believe is true to what we believe the recovery rate to be. And as I mentioned, it's now less than 0.5% of the fund, but we are very open and honest with all of our clients about any of the issues we're experiencing in the portfolio. And barring that one for Genesis Care, all other loans remain very much at or near our original base case and nowhere near default and paying interest and not capitalising.
Thanks, Bob. Simon, just a question about commercial mortgage-backed securities. It's sort of a part of the portfolio that you don't see too often in ABS portfolios. Could you just talk a little bit more about the underlying assets there?
Yeah, so these are sort of the one transaction we're involved with. The average loan size is around 2 million per transaction. There's roughly 200 loans. They're relatively short dated, and the average LVR on the pool is sort of 57%. So we expect the valuations to have come down a little bit since then, but we've got significantly strong buffers of protection based on the LVR, as well as the originator has a pretty significant first loss position in front of us, and they're very well capitalised and have shown strong support to the business. So we feel comfortable about that. We don't think it's a huge opportunity to become a really big part of the portfolio, but selectively with the right originators, we've found good relative value and good alpha for the book.
And in that particular case, we've looked at their credit underwriting standards, given we're lenders ourselves, and what we really look for is stabilised property that forms a security, but more so the cash flow from those properties service the loan comfortably, even under higher interest rates. So we really look at serviceability being the first port of call, and then the ability for the lender to sell that particular property as a secondary way out, rather than the only way out that you see in many real estate lending opportunities.
Thanks, Bob and Simon. Just a question about the underlying loans in the portfolio. So you mentioned there were 47 positions at the moment in Private Debt Fund 2. Does that include the underlying warehouses and underlying loans there, or is that just at the top level?
No, that's at the top level. So yeah, each warehouse will have hundreds, if not thousands or tens of thousands of underlying loans. We're not adding up all of those to count them.
But indeed, they've got a lot of tranches as well within those warehouses. So we're not counting the individual tranches of those particular warehouses. So if we're exposed to one particular mortgage warehouse, for instance, it might be all the way down from single A to double V, but we count that as one exposure for the purposes of that 47 loan count.
Thanks, guys. Just a question from me. So, I mean, the portfolio is, as you mentioned, broadly 50% ABS, 50% LBO at this stage, with very, very little exposure to real estate debt. In what circumstance would you look to dial up the real estate debt exposure in the portfolio?
Look, in the past, if past is any reflection of what is to come, we feel as though when there's a dislocation in real estate, which looks like there's a number of factors that are contributing to the view that might happen, there is a real opportunity for patient capital to come in and provide very valuable capital at a very attractive return. And we have a reminder, our return hurdle is RBA cash plus 4 to 5% through the cycle. Now, if we see the banks in particular pulling back, because our biggest competitor in lending to very good quality properties with good quality tenants at conservative LVRs has been that banks have been very aggressive in providing those sorts of loans at well under our return hurdle. But if the banks start to step out of that market because of the fact that they're overexposed, or they see real estate as being at this point in time, something they want to dial down, then we can easily provide, good quality patient capital to quality assets at a point in the cycle where it's very attractive to our investors. So we remain vigilant of those sorts of opportunities. And we feel as though maybe the next 12 months, there could be more of those sorts of opportunities.
Thanks, Bob. Simon, just a question about the sort of US Australia relative value comparisons you talked about in the presentation. Have you modelled Australian consumer finance pre-2010? Brendan's saying here that he notes that the US model dates back to 2000.
Yeah. So we've seen the graphs and the data going back to sort of 2000, but it's sort of, we don't actually have access to the data, but we've seen the kind of levels that it got to, and it really didn't sort of peak above 6.5% type of default rates in Australia. So generally, historically, Australia's always performed better than the US. I think going forward, you can't assume that that's going to hold forever, but I think it's pretty likely, and that, that correlation with unemployment is pretty strong, and we do see that as, something that will continue.
Do you want to talk about rating methodologies and the fact that they're very US-centric and they're really calibrated for the worst cases globally?
Yeah, I think across the portfolio, we do benefit from the fact that, the major rating agencies, Standard & Poor's and Moody's and Fitch are very, US-centric. And so we do get the benefit of the calibration of all of the models being through a US or global lens. So we really, benefit from the worst case, scenarios that happened during the US, subprime effect, and then even like Ireland, like the housing declines in Ireland. And so the rating levels and the level of enhancement is sort of stressed to be able to withstand those type of global shocks. And, we feel, we benefit on all our investments from those type of stress levels.
Thanks, Simon. Probably time for one last question. So, you touched on some of the stress testing that you put the portfolio through on the ABS side. Could you maybe just talk through that a little bit more detail in terms of sort of what unemployment rates you're looking for the portfolio to withstand, the types of protections that are in ABS warehouses for investors and so on?
Yeah, so I guess the broad statement would be we're generally preparing for a really severe recession, and we want all our investments to be able to withstand, a recession where we do get unemployment going sort of above 10% and staying there, and then house prices falling by greater than 30%, and rates a lot higher. I think we're not sort of trying to go into transactions in the hope that we can forecast economic conditions to be just right, so we just sort of scrape through. We're trying to go into every investment, so we've got a very large margin of safety that, if the actual realised outcome for the economy is sort of nowhere near our worst case stress, then all of our investments should sail through easily. And that's a common trade that we also do on the LBO side of the portfolio as well.
Yeah, and I guess just to add to that, we get very timely information, particularly on the ABS side of the portfolio. We get monthly information on every one of these warehouse deals that we enter into, and it's down to loan level detail. And we see trends like 30-day arrears, 60-day arrears, 90-day arrears, any losses coming through the portfolio on a monthly basis. And we watch that, and obviously Leadenhall, as the valuation agent, is independent of us, looks at those reports very closely. And we look for any trends that start to look like anywhere up to where our trigger might be for a stop origination event or well before a default event. And there's various things that we can do being private side where we can arrest a deteriorating situation in an ABS pool. Remember, these non-bank lenders have got a very real incentive to make sure that these warehouse pools are kept in very good shape, because that really is their front-end origination. There would be no capital markets issue into the capital markets if these warehouses start to underperform. So in many cases, we can ask for greater equity in terms of credit enhancement. we can tighten up the eligibility criteria of what is eligible to be funded in our pools. Indeed, some of these non-bank lenders in the past have taken non-performing loans out of these pools and separately financed them on their own balance sheet. So there's a number of levers that we can actually pull to arrest a deteriorating situation. And I would say these ABS pools and warehouses are amongst the most tightest covenanted structures in the loan that you can come across. So every single dollar coming in terms of a loan repayment or receivable in a pool is dealt with in a very, very regimented way that's been documented from day one. So these are sorts of structural protections we rely on as a lender to these warehouse deals. And our clients should be very confident that we've got various layers of buffer before we suffer our first dollar losses, as sort of Simon went through.
Yeah, and we're not just sitting on our hands. We've been actively preempting, a slowdown in the economy and a lift in unemployment, and we've been tweaking the eligibility criteria and portfolio parameters of these warehouses in anticipation of weak conditions to come. So it is a very active investment.
I think we might leave it there. Thanks, Bob. Thanks, Simon. And thanks to everyone that's dialed in today for your attention and interest in Revolution Asset Management. As always, if you have any questions, please reach out to your contact on the screen here from Channel Capital. And I know Bob and Simon are always very good with their time if you'd like to meet with them directly with us. But thanks again and have a great day.
Thanks, everybody.